Today we will do a deep dive into the science of dividends, which signals investors are receiving when they get a dividend from a stock, and why value investors treat dividends as a sufficient seal of quality. In today's world of quadrupling semiconductor and AI stocks, with CEOs promising to become profitable soon, justifying current losses by developing the latest and greatest technology. This technological promise may or may not result in future astronomical earnings. But first, it pushes stock prices higher and higher. This phenomenon is also called hype. Value investors tend to watch hype from the sidelines. As other investors may make triple-digit returns, their risk of failure does not compensate in the view of a value investor. And here comes the science of dividends into play. Since instead of blindly trusting CEOs' promised future earnings, dividends are one of the strongest signals. When investors receive dividends on their deposit cash account, the CEO's promises transform into real cash flow, besides the earnings the company keeps to reinvest. In the world of finance, control is a very important factor, and when a company pays dividends, it loses control over a certain amount of its earnings, signaling strong trust in its own capabilities to generate new earnings. On the other hand, dividends can also signal the opposite, like milk going sour, when the company is paying a high dividend from its substance, or even worse, with debt. As Miller and Modigliani showed in 1961, dividends in theory do not have any positive impact on stocks compared to stocks reinvesting earnings. The magical phrase here is "in theory", since Miller and Modigliani showed this effect in a perfectly efficient market with the absence of taxes, bankruptcy costs, agency costs, and asymmetrical information. As we know, theory and practice differ at the stock market. As other studies showed, the following three most important positive effects of dividends. First, the value signal. Stocks paying dividends have a tremendous value signal, meaning management is confident about generating future earnings, maturity of the business, trust in its management, and trust in its cash flow stability. Take Sysco, the food supplier, as dividend king. They are pretty confident to pay and increase the dividend in the future. Even if the demand for food might drop like during the pandemic, investors translate the astonishing 52 years of dividend increase streak into a signal of trust. This consistency has such a power that value investors tend to favor it over fast-growing, hyped stocks because of its boringness associated with its consistency. So dividends signal consistency, which is one key to building trust. Back to the next positive effect of dividends, which is called the governance effect, meaning dividends keep the incentive structure on the management board on the long-term and defensive track. This means management might not invest in venture-sum strategies such as overly leveraging to finance a merger. Instead, it focuses on the core business and tries to grow organically with a decent amount of risk. A great example is Coca-Cola, with a defensive yet super long-term view, as Berkshire CEO Greg Abel identified Coke as a forever stock, partially because of how the company is managed. Coke has increased its dividends for 64 consecutive years. This was possible by disciplined management, as they did not rush to follow the energy drink hype. Instead, they went a dual strategy. First, Coke bought a 16.7% stake in Monster Energy and became its strategic partner when it comes to distributing and bottling. Second, Coke tried to enter the energy beverages with Coke Energy by its in-house production. As Coke Energy did not transform into the success story, the stake in Monster did. And this is exactly what shows the defensive and strategic governance effect, which gets intensified by the dividends. And finally, dividend stocks come with significantly lower volatility, which usually helps private investors to stay invested instead of rushing in and out. Let's compare Procter & Gamble, a dividend king increasing dividends for 69 consecutive years, with Palantir, a super fast growth stock, paying no dividends. Looking at the drawdown chart from the past 20 years, Procter & Gamble had its most severe crash during the finance crisis with a maximum drawdown of 40%. Palantir, which went public in 2020, already tops Procter & Gamble's most severe crash with a maximum drawdown of 84% in 2022. Why does this matter? Well, humans' psychology weighs the fear of a loss stronger than the possibility of a gain. This results in a sell during a crash, defeating the purpose of long-term investing. Additionally, we should minimize the risk of failure, which gets proportionally increased by such severe drawdowns. So the science of dividends reveals the major factors: the value signal, the governance effect, and the low volatility effect, as we aim to save for our future selves, retirement, and family. These core values most likely fit best. Companies with a high dividend and a high payout ratio disqualify as great investments, while a low single-digit and consistently increased dividend underlines the strength of a stock. So yes, they are also great in defensive stocks paying no dividends like Boston Scientific. It's important to add that dividends are a sufficient condition for value investors. So paying dividends is sufficient but not necessary for being a stable defensive stock. Thanks for watching and see you in the next video.